You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi, it's Jake here. Welcome to The Voluntary Life. This episode is a book review of the book A Random Walk Down Wall Street by Burton Malkiel. And what I'd like to do is give you an overview of the book. I've just read it. I'll share some of my thoughts about it and also talk about some of the themes and topics that it raises. This will be relevant for you if you're interested in saving and investing, financial freedom, financial independence, and all those good things. So this book, A Random Walk Down Wall Street, is a very famous book, very influential. It's one of the books that founded the whole approach towards investing called passive investing. So Burton Malkiel makes the argument in this book that investment markets are unpredictable and that the transaction costs that you incur when you try and trade around actively, do what's called active investing, make the whole approach essentially a waste of money. And he advocates in this book a different approach to investing, which is called passive investing, which is a totally different approach. It doesn't rely on investment advisors to tell you what the hot tips are for the next thing to buy. And it takes a much more sort of low-cost, so-called passive approach to investing, which I'll explain a bit as we go along. So just in terms of what is in the book starts off with a kind of historical overview of investment markets, principally in the US. And he talks about big things that happened over the last 100 years. The 1929 crash, the sort of post-war period in the 50s and 60s, what happened during the 1970s, the 1987 crash. He talks about the dot-com boom and the crash in the early 2000s. And he kind of goes through and provides a commentary on the history of the market from his perspective. Then he provides a critique of what investment advisors do and what their theories are for advising you on how to invest your money. So he looks at the ideas that investment advisors who get paid to put people's money in particular places that they think that their expertise will help earn a good return. He looks at their ideas and he provides a critique of these ideas. And essentially he goes through the two main approaches to active investing. One is called technical analysis and the other is called fundamental analysis. And he provides a critique of both of those. And then he outlines this alternative approach, which is called passive investing. And in that approach, rather than pay someone to tell you which stocks to buy, because according to their expertise, these stocks are going to go up in value, the passive investing approach is to buy into what's called an index fund, which is essentially a fund that just tries to hold a representation of the entire stock market. And what an index fund does is just try to match the overall performance of the stock market as a whole without trying to pick individual companies that are going to do better or worse. So it's called an index because if you take all the shares and look at the weighted performance of all shares in the market, you can create an index, and an index fund essentially just try and track that index. And they do this by buying shares in many, many companies, starting with the biggest ones and down to even very small companies. So they buy typically, 500 shares in over 500 companies. And in the book, Burton Malkiel outlines this approach to passive investing. And as well as the index funds, another aspect of passive investing is to use some of the insights from what's called portfolio theory, which is the idea of diversifying, basically. So as well as buying shares, you buy some bonds and you have a fixed amount of shares and bonds and you rebalance between the two so that if one does badly, then you have the other one to kind of back you up. That's what is talked about in this approach in the book. And he finishes the book by providing advice on the basis of his analysis and his critique of active investors. And he essentially gives some tips as to what he thinks some sound policies are for your personal finances. And his advice is now very mainstream. Things like owning your own home, using tax-deferred accounts, saving regularly, saving consistently, buying index funds. It's very, very straightforward financial advice that is now totally the mainstream. So that's a summary of the book. The reason that the book was really influential is because the message that investment markets are unpredictable and that therefore it doesn't make sense to pay someone to try and make money for you in investment markets. That message is a direct challenge to a huge industry. I mean, there's a lot of investment advisors making money on the basis of their so-called expertise as to where they can put your funds for you in order to realize a return that's greater than the market. And this book challenges that. He's not the first person to have challenged that, but he provides a really detailed critique of what it is that investment advisors are doing and why it's a waste of money to go for an active investing approach. So he goes through and he does a critique of technical analysis, the so-called approach of charting, which is essentially to look for patterns in stock charts and look for correlations between stock prices and other economic variables, or any variable really. And he provides a critique as to why this doesn't reliably allow you to beat the market. Why essentially, although it looks semi-scientific to be looking at patterns of stock charts, and although there's a lot of terminology around stock charts like head and shoulders patterns and this, that and the other, he provides a lot of examples of statistical research that shows that the kind of patterns people see in stock charts and think are significant, you see in any random series, such as you would get from flipping a coin. And he provides a lot of evidence to show that although these correlations look scientific and although they sound very scientific, they're just like reading tea leaves. There is no scientific basis to them whatsoever, and they don't provide a fundamental basis of predictability. I mean, he doesn't use these words, but what he's showing is that they're just bullshit, although they can be extremely highly priced bullshit. So the second type of investment advisor approach that he critiques in the book is that of fundamental analysis. Fundamental analysis is the approach where, rather than looking at a stock chart and trying to find patterns, it's an approach to look at individual companies and to look at their performance and to try and identify companies that essentially produce good returns but are currently undervalued by the market. So it's looking for companies that are going to give good dividends and good growth in the value of their shares, but the market hasn't recognized that, and so currently they are selling at a discount in terms of their share price within the marketplace. And it's basically the approach of looking for bargains in share prices, trying to identify companies that really should be valued more given the dividends that they produce and the profitability of the company and the growth potential and so forth, but are currently selling at a bargain. And this is the approach that Warren Buffett takes, allegedly. I mean, that's the approach he says he takes, although he's done lots of things that many people think don't fit within this sort of framework too. And the author Burton Malkiel certainly has a lot more respect for this approach than he does for the technical analysis approach, but he still goes on to show why fundamental analysis, again, cannot provide reliable prediction of future value. And he goes through and talks through all of the assumptions that are required about future levels of profitability and about future growth, and how easy it is to change assumptions in fundamental analysis and come out with completely different valuations, and how much subjectivity is involved. But also he talks about all the factors that, even if analysts is quite rigorous in their approach, all the external factors that can change the valuation of a company without the fundamental analyst being able to predict that. And he shows how that makes this approach not reliable as a prediction tool. And having gone through and talked about sort of what's wrong in the theory of the active investors who say that they can beat the market, he then goes on to provide a lot of evidence as to the basic fact that active investors as a group have failed to outperform the market in every study that's been done of them. So if you look at all the active investment funds, which are supposed to have experts who are able to seek out good bargains or find good technical patterns and beat the market, when you actually look at their performance, they always underperform the index of the market average as a whole. Not only do they underperform, but it's likely that they underperform a lot worse because the statistics are always skewed by the fact that when funds go out of existence, they're not reported in the data. So there's something called survivorship bias and so forth. And you can read the book if you want to get into more detail about that. But essentially, to cut a long story short, he provides empirical evidence to show that those people who entrusted their money to investment advisors who supposedly had expertise that was going to help them beat the market. On all of the studies that he looks at, those people always did worse than people who just were able to use an index fund to get the average return of the market. And he goes on to explain why this is, that even if you do have some supposed expertise in stock picking, you still incur transaction costs every time you switch from one stock to another, and you still incur tax costs every time you switch from one stock to another. So the more dealing you try and do to, pick the latest hot stock and sell it when it's about to go down and then buy something that's about to go up, the more you mess about, basically, the more cost you incur. And that in itself puts you at a disadvantage as an active investor compared to a passive investor who just buys an index fund and holds it for the long term. And he goes on to say that, that even though there are sometimes the odd active investor who outperforms the market, statistically you would expect that to be the case anyway. If you have 1,000 people throwing dice and they all throw continuous rounds of dice, there's going to be one or two who after 10 rounds will have only thrown heads. And it's not because they've got any expertise. It's just because with enough people trying to beat the market, one or two people are just going to happen to pick the right strategy, but it's not predictable and it's not scientific. So having said all of this, he goes on to provide, as I said, some general advice, which is fairly mainstream, about using index funds, going for low-cost investments, using tax-deferred accounts, buying your own home and this kind of thing. So that's a general overview of the book, and I thought I'd just share with you some thoughts about it and some criticisms I've got of the book. I am overall a big fan of passive investment, and I do think the overall message of this book is great. I very much appreciate, the debunking of financial advisors and the unmasking of so-called expertise in beating the market for the nonsense that it is. But I do have some criticisms of the book too, so I'll share those with you. This book provides a history of the stock market. As I said, he goes through and talks through all of the sort of key turning points in investment history in the last 100 years. And I think it's a very, very limited view of the stock market, because he doesn't talk at all in this book about the role of central banks and the role of monetary policy. And essentially, he doesn't talk about how governments can manipulate the money supply, how central banks can manipulate interest rates, and how through the fractional reserve banking system that permeates through the whole economy and has huge impacts on investment decisions, on the prices of shares and so forth. And that is a very big topic, and I won't go into it in detail in this podcast. But the basic point that I want to make is that if you read the history in this book, you're not going to understand why there was a boom and a crash in 1929. You're not going to understand what happened in the 1970s with stagflation and so forth. And if you do want to understand those things, which I think is really important to understand, the book that I would recommend is a book called What Has Government Done to Our Money by Murray Rothbard. And that really explains the impact of monetary policy on the economy as a whole and on investors, on share prices and various other things. So I highly recommend that book. I'll put a link in the show notes if you're interested. The next criticism that I have of this book is that because Burton Malkiel is an academic, I think he's been a professor in Princeton for decades, there's a lot of academic discussion in this book which is both confused and irrelevant to you as an individual investor who wants to get on and find the right way to protect your money and get a good return on your savings. He explains that stock prices are not systematically predictable, which I think is great and true and very helpful and useful. So don't go and spend money on investment advisors because they don't know how to beat the market. Nobody does, because stock prices are unpredictable. But he then goes on to provide an explanation as to why stock market prices are unpredictable, which is totally confused and totally confusing. And he goes into a discussion about so-called efficient market theory. And this is the idea that you can't predict stock prices because all information that is known is already incorporated into the stock price. And there's instantaneous information transfer and people know about things already. So that's why you can't predict stock prices. And then he talks about the debates that this causes, because other people say, no, markets aren't efficient and not all information is included. And the author goes back and forth on this and says, I suppose there are sometimes bits of information that are not included. Maybe markets aren't totally efficient and so forth. I believe that this is all beside the point, because the reason that you can't predict stock prices is nothing to do with the efficiency of the market. It's to do with the fact that social sciences are not the same as physical sciences, because humans can change their behavior. So you can have laws of motion for physical objects that don't have a will of their own and they aren't able to learn the fundamental difference being learned. But you can't have predictable laws for any aspect of human behavior which involves humans learning. So this is a confusion that has happened in economics in the 20th century, the idea of treating economics as if it were a physical science. If you're interested in this whole discussion about whether or not economics is a science in the same way as the physical sciences, or whether economics is a science in a different way, because human behavior itself involves subjects that can change, and that's not the same as the physical sciences, then I recommend a book called Economic Science and the Austrian Method by Hans Hermann Hoppe. I'll put that in the show notes. It's a technical book and it's very much focused on this kind of in-depth discussion about methodology, but that's just a brief comment on some of the philosophical problems that I noticed in this book, A Random Walk Down Wall Street. Burton Malkiel, funnily enough, actually points this out about humans being able to learn and that being the key problem. And he mentions this, but then he goes off on the whole debate about efficient market theory again, which is kind of a waste of time. And he mentions it in regard to the stock market, which is a great example of why you can't predict human behavior because humans learn. Because he points out that the moment you come up with any kind of useful regularity in the stock market that you can use to beat the market, then people are capable of learning it, and therefore they're capable of removing that regularity. And he points out how, this is what he thinks has happened with some stock picking strategies. Like there was a strategy in the early 90s that was to do with a change in prices towards the end of the year because of various institutional reasons of investors changing. I can't even remember if it was buying or selling at the end of the year. And you could take advantage of this blip in prices at the end of the calendar year. But as soon as people started to realize that this was a possibility, everybody tried to take advantage of it, and the pattern was erased because people started buying stocks before the end of the year, earlier and earlier and earlier, until there was no longer any discernible pattern to use. Now, what's important is not how efficiently people will learn. The important point is people can learn. And so any regularity, people can change their behavior, so you can't predict them. And what this means is that investing, like entrepreneurship, is an art. It's not a science. If you want to go and put your money into a company, you're not going to find a scientific law that's going to tell you whether or not you're going to get a return. You are gambling, ultimately, just as you're gambling to a certain degree when you create a company and become an entrepreneur. It's an art, not a science. And those investment advisors that pretend to be scientists and have an air of technical prowess and know-how and so forth are essentially trying to make their expertise look systematic when that's really impossible. So that's one criticism I have, is just that although I think the message overall that you can't predict stock prices is an important one and has important consequences, his explanation of why is a really pointless academic debate about the efficiency of markets, which to me just doesn't seem to be relevant at all and is actually just confusing the issue. The next criticism I've got is that if you're interested in index investing and you just want to take advantage of the things that you can do as a passive investor, then there are books out there that I think give you that message more directly without, for example, all of this academic discussion about efficient market theory and all of that. And I would recommend John Bogle's book. Bogle is the founder of the Vanguard Fund, which is the first sort of major index investing fund. And I'll put a link in the show notes. His book is called, I think, Common Sense Investing. And he gives an overview of what passive investing is, and it's a much more straightforward, down to earth description geared towards you as a saver and investor without some of these academic debates and confusions. The next criticism I've got is that in this book, A Random Walk Down Wall Street, Burton Malkiel recommends diversification, but he only recommends diversifying between stocks and bonds. I think that all of the reasons that he gives for that level of diversification apply even further to diversifying beyond just stocks and bonds into, for example, precious metals and holding some cash too. I've been convinced of this by reading the book Fail-Safe Investing by Harry Browne, which talks about the approach called the permanent portfolio, which I've mentioned before. And that approach is really to look at diversification and to look at the benefits that it brings and to identify that the main benefit is to diversify into different asset classes and to choose asset classes that, for structural reasons, are going to perform differently in different economic conditions. So the approach is to basically say, we can't predict the market, we can't predict what's going to happen to the economy, we don't know what's going to happen, and it's a lot more honest and clear-headed to just admit that we don't know. But what we can do is we can look at all of the range of possible economic circumstances, and we can identify what would have to happen if that economic circumstance occurred. Even that is not necessarily certain. So, for example, we don't know if we're going to get hyperinflation, but we do know that if hyperinflation does happen, then money is going to rush out of cash and it's going to go into the most secure inflation-protected assets, for example, gold. Now, there's no guarantee that even that is going to happen, but this is an approach to diversification which sort of protects you within the knowledge that you can't predict what's going to happen and gives you adequate coverage whatever would happen to the economy. So my critique of this book, A Random Walk Down Wall Street, is that it doesn't cover all economic circumstances in the diversification between bonds and stocks that is recommended. And I would really suggest that you look at Harry Browne's book, Fail-Safe Investing, and the permanent portfolio, which to me is a far better approach. I also have a criticism of his suggestions for personal finance. As I've said a couple of times already, he provides very mainstream suggestions, which are sensible, like consistently saving, using tax-deferred accounts. But I also see some real limitations of his advice. There's just 2 points that I want to go through. One is that he recommends buying your own home. And that's such a huge financial commitment for people that if you do buy your own home, that actually becomes your basic strategy. Property becomes the vast majority of your investment portfolio for most people, and especially if you're young and you're starting out. And consequently, I think that it becomes a bit like an elephant in the room that you have to try and arrange all the furniture around in terms of your investment strategy. And there are lots of people who've criticized property ownership as being not necessarily a good investment, especially in some periods of the economy. Again, Harry Browne has a lot of criticisms of that strategy of home ownership as a personal investment. There are pros and cons on both sides, but I would just say that it's not necessarily the best thing in the world to focus all of your investment on owning a home. But in this book, A Random Walk Down Wall Street, he sort of treats it as a no-brainer to own your own home. Another criticism I've got is that he doesn't provide any perspective on the kind of more intensive saving or extreme saving approaches that I've talked about in some previous podcasts, that there are people who take the approach that if you want to get financial freedom, it's not just saving, 5% of your income per annum on a regular basis. Some people try and save more than 50% of their income. They go really hardcore to try and get to a level of financial independence as quickly as possible. And he doesn't talk about any of those kinds of approaches in this book. So it's a very much a mainstream idea of saving. And I think it's worth thinking about other approaches to your personal finances. Again, I would recommend checking out the blog Mr. Money Moustache and the blog Early Retirement Extreme for people who are taking more of that kind of approach. So those are just some criticisms that I have of the book and thoughts about some of the issues that are raised by the book. Overall, though, I do think passive investing is great and that it doesn't make sense to entrust your money to investment advisors who think they can beat the market, because they can't. And this book has been an influential book in getting that message out there, which I think is great. It does also provide a lot of background to investment terminology and basic investment ideas, and I haven't really had time in this podcast to explain some things in detail. So you might find it interesting, but as I said, I've recommended a few others that I would personally prefer. Harry Brown's book, Fail-Safe Investing, is by far the best. If you're interested in passive investing, I think John Bogle's book is better. And if you're interested in understanding some of the aspects of the economy that are not covered in A Random Walk Down Wall Street, such as the role of central banks and fractional reserve banking, then I recommend reading What Has Government Done to Our Money by Murray Rothbard. So I hope that's useful. Do let me know what you think. Love to hear any feedback from you. Don't forget to check out my new book. You can find a link on my website or by looking in Amazon under my name, Jake Desyllas, Desyllas. The book is called Becoming an Entrepreneur: How to Find Freedom and Fulfillment as a Business Owner. Thank you so much for listening.
Thank you for listening to The Voluntary Life. If you have feedback about the show, please email jake@thevoluntarylife.com. If you enjoyed this program, please share the podcast with your friends or click the donate button on thevoluntarylife.com.